Hey folks, David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis. Today is Thursday, October 1, 2015. Here's a daily chart of the SPY, which is the mirror image, for the S&P 500. And we had a good close today. So the market started down, looked like it was going to sell off and fail. And then they kind of saved it, and who they are is the institutions. They saved it in the afternoon, and they closed at an all-important level that we spoke about last night, which is the high from the 28th, which was 191.91 on the spider. And today we closed at 192.16. So what that does for us is it gives us the first indication that they're probably going to push this market up a little bit higher. And now we're looking for the resistance points that I put in here last night, 193.03, 194.91, 196.79. I don't know if we get up that high, but we could. Probably we're looking at a back and forth type of rally with an upward bias, I'll call it, for about a week or so. Maybe less, maybe more. But that's generally what we're looking for. We'll take it one day at a time. But what we're looking for is to also begin to accumulate some more shorts when we get larger rallies than we had today. For today, the spider was up 58 cents, 1/3%. I wouldn't exactly call that a rally, but it's a positive day in terms of what they accomplished. And what they accomplished was a close above the 28th, which was important at 191.91, and that's what we talked about last night. So that was step one. If we didn't close above that number, then the probabilities of a further rally would be reduced. So they're not reduced. In fact, they're increased, and that's what we're looking for tomorrow or into next week. But tomorrow, keep in mind, we have the phony jobs number going to be reported at 8:30 in the morning. How's the market going to react according to whatever the number that they try and tell us it is? No idea. We have no idea. We don't know what the number's going to be. They pull it out of a hat first thing in the morning, and they report it at 8:30, and then all of a sudden the market's going to do what it's going to do. It generally will go in the first direction it goes. In terms of the futures, it will normally reverse after that and go in the other direction. That's not normally the way it works, but we're not concerned with that. It's all nonsense. What we're concerned with is what happens or how the market reacts from that number tomorrow or as a result of that number, and are we going to see a further follow-through rally into the first resistance point at 193 and change, and then to the second one, and that's what we're looking for. So basically, in simple terms, we're looking for this, okay? Let's take the pivot high here from Fed Day. We're looking at a down move. We're looking at a corrective rally somewhere up in this neighborhood, maybe higher. We don't know yet. And then we're looking for a further down move. And that's basically, in a nutshell, what we're looking for. Let's not make it any more complex than it is. How high does this rally take us? It's anybody's guess at this point. I'm giving you the resistance points that the market should find resistance here, here, and here, okay? And we don't know exactly where it's going to stop. Maybe we even fill the gap. That's possible. Maybe we even come into the 50-period moving average, and by the time we got up there, that would fill the gap, and then we turn back down. Here's the bottom line, folks. The institutions are going to do what they're going to do with this market. They have enough capital to push the market around. And if we get some kind of a news event that sparks the market in one way or the other, that's going to be the case. But in terms of volume today, if you look down here at the volume, we saw decreasing volume, not terrible volume, 126.7 million shares. That's not terrible volume, but it's decent volume. And what it tells you is there were some buyers in the market this afternoon. And that's basically where it was. And if we just look, and then I'm going to move on because I don't need to belabor this point, but if we look at the short term, like for example, the 10-minute chart here, okay, so we made a low, okay, and now all of a sudden the market sparked some kind of a rally off of whatever it was, and we headed higher today. And we headed higher not because of some news event, not because of some spark in the market. We headed higher because the institutions decided to close the market above 191.91, and that's just the bottom line. This was the line in the sand. We closed above it, and that increases the probability of a further rally higher. And that's just the way it works, okay? This isn't about the news events. It's not about what's reported on CNBC. It's about what the institutions decided to do. And what I think they decided to do is take this market higher. Let's shake out some shorts. Let's get some short covering going over the next several days, and then they'll turn it back down again. That's the way it works. Each and every time. That's just the way it works. So we're going to go with that for the time being, and that's the bottom line. IWM was flat today, down 7 cents. That's flat. Nothing to see there. But I will tell you that the VIX was a tell today. Was watching the VIX all day long. And if you look at the 10-minute chart, the VIX was basically trending lower all day, even while the market was trending lower. That was my first signal and my first indication that the market was most likely going to turn around and make a run for the roses, as I told one member earlier today in an email who was asking about the 191.91. And I saw the VIX. I didn't tell the member this, but I should have. But I saw the VIX, and the VIX was telling me that they were going to make a run for the roses and try and close above 191.91 in the spider. And that's exactly what happened. What happened in the transports? Up 0.6%, up 47 points. And that was another indicator that they were going to try and rally the spider come heck or high water, and we'll leave it at that. The NASDAQ composite finished positive, but mainly flat, up less than 7 points. Nothing to see there. And that's basically the market in a nutshell. Other than what we discussed last night, nothing changed, only the fact that we closed above the 191.91, which is an important level, a very important level. All right, so let's go over to gold. Let's go to the daily chart. Nothing happened. Gold was down a couple of bucks today. Nothing to see there. I do want to make mention of something, and this is really, really important. I got an email from a long-standing member last night, and what he did was he made it a point to point out to me that based on a chart pattern or a chart setup that I was talking about with the spider for a long time when the spider made the triangle pattern. In fact, let me go back. This is a great lesson. Great lesson. When I was pointing out that that I'm going to do a rough drawing here, that the spider was making a basically a triangle pattern here, okay? And I was indicating to them, this is not the pattern that I was looking at. This is a rough drawing. This isn't really one. I'm going to do it over. That's not what I wanted to show you. But what the member was showing me was that basically when I was pointing out a triangle pattern and that the spider was running out of time, and when it did run out of time, it was going to break one way or the other, and I was telling you what all my other indicators were telling me it was going to break to the downside, okay? What he did was he took that very information and he applied it to the gold market. And we're going to do that right now. And it's not a perfect triangle, but my gosh, it's a pretty good one. And it's very interesting because it's certainly of note. Now, we can play games with where to take the number from and where to take the number to, but that's not what's important. What's important is that that particular member is learning. And what he did was he learned enough by my spider chart and my pointing out a triangle pattern in the spider. And, well, that's not the pattern that he was telling me. It was from a higher number. Okay, I think it was from here. And forgive me for not remembering exactly where you took it from, but it's a good enough pattern. It's a good enough chart structure. We'll leave it at that, telling us that maybe gold is formatting or making the same formation in roughly the same manner as the spider chart that I showed you that was coming to the end of a triangle pattern. And what we're doing is we're seeing a trend line on the bottom, a trend line on the top. It's not perfect, but it's pretty darn good. And it's good enough to be of note. And number one, I want to congratulate the member and I want to thank the member for pointing it out to me because I didn't see this. And that's where what's important is, even I learned something from that member as a result of him learning from me. And that's what this is all about. The important thing is that if you take the information I tell you and you're able to apply it to other markets, other chart patterns, other time frames, and then you see something that I didn't see, that's how we help each other. That's what it's all about. Traders help each other. We're all lined up together. The institutions are lined up together, and all the retail traders are lined up together. And what I do is I try and point out to you on how we can stay on the same side as the institutions. Sometimes I see it clearly, sometimes I don't. But the point is that member, and thank you again, you know who you are, saw something that I didn't see. And while it's not a picture-perfect triangle pattern, it's certainly good enough to have an awareness of what's developing here in the gold market. And I want to thank that member, and I want to point it out because it's helpful to me, and then I can reiterate that to other members that not only do my cycles point higher, but that member pointed out that we may see another formation of a triangle pattern, and we're basically at the lower end of the triangle formation. And I want to just point that out to everybody because we could be seeing a move higher, and it could be certainly helpful to understand where the bottom portion of this triangle pattern is. And that's what it's all about. We're here to help each other. I help you as much as I can. And when you can help me, that makes my day. And that's what I told the member last night. He made my day because what I taught him, what I taught you in certain cases was helpful, and he turned around and taught me something. And I think that's fantastic. So nothing changed in gold because we didn't have a lot of price movement, but the only thing that did change in gold was that I'm able to put some trend lines on the chart here that was able to be helpful in my mind. It was close enough to be helpful to re-point it out to you guys so that everybody is aware of what's going on. So I thank that member again. You know who you are. It's a wonderful thing that we can all learn from each other. Okay, let's go to oil. And what was interesting in oil today was that oil tried to make a spike higher and failed. So a couple of things I take from that. On a bigger time frame, I take the fact that the bullish pattern is potentially still intact here and tried to make a run higher but failed. And the fact that it failed tells me that the more prevalent pattern on a shorter duration is the bearish pattern here. And that's what may be failing, maybe not. We have to see that develop. At the end of the day, the oil market was basically flat. But what we did see was we saw a potential run higher and a failure. And where did we see that failure? Let me get rid of this line. The high from the 23rd was 47.15. The high today was 47.10. We couldn't even get to the top of this candle here. And that is of importance. It's something we want to note, and it's something we want to watch. It's a failure at right below a very important level. So what that tells me is I'm watching that this shorter duration bearish pattern is potentially playing out. And that's kind of the front burner information in my mind. So that's all we have to report in crude oil today. So with that, we'll just move on to the bond market. And the bond market basically had a stall day, but what can we take out of the bond market today? I'm taking something out of it, and I know you're looking at the same thing. What is this? This is a narrow body candle bar. It's kind of a doji candle bar. And what does that signify? That signifies a trend change or a possible trend change, and that's what we're watching moving forward. So if that's the case, and we are seeing a trend change from this up move here, then we will see a further down move or a down move coming in the price of bonds, which means yields would move higher. So I think it's important that we saw this narrow candle here or doji candle, and I'm watching that closely because normally that will signify a trend change. Okay, so that's all we really have to report in the price of bonds, in the bond market. Yields potentially going higher, price of bonds potentially going lower. very important level up here that we want to pay attention to, okay? And as long as we don't go above that level, then the bearish case for bonds would still be intact, watching very closely. And I suspect that whatever is reported tomorrow from the employment report, the phony jobs number, will have an impact on the dollar. It will have an impact on the stock market. It will have an impact on the bond market, and we'll see how that plays out tomorrow. Speaking of the dollar, not much movement today in the dollar. Certainly intact is our bullish pattern that we've been watching. Okay, upward move, sideways, building some pressure, building some energy for another up move. We still are stalling out at the 50-period moving average and the convergence of the 50-period and the 200-period, which is this black slope, upsloping trend line. We're seeing a stall out of the convergence, of those two moving averages, and therefore it's not a wonder that we saw a stall out today or a little bit of a downtick in the dollar. But I fully expect the market to continue higher in the dollar unless we see some kind of a wacky move off the phony jobs number. Wacky move off the phony number. How's that for you? But that's what we see. So higher prices coming in the dollar day to day. We don't exactly know or what it's going to do. However, we know that the trend should be higher in the dollar from this point forward, and we'll leave it at that. Not much movement. Don't need to waste a lot of time on that. Natural gas, well, I got to clear out this chart. Bear with me. Natural gas, what a surprise. We saw another down day in natural gas. But here's one for you. We saw a continuation of the down move, but we saw three equal down days in a row and on volume. So what I'm going to suggest, and I'm not suggesting anybody trade this, I'm just suggesting that we're probably going to see some kind of a short-term bottom put in here. Some kind of and we'll call it an exhaustion move on the downside. Something that tells us 3 down equal days generally will tell me we're probably going to see some kind of a pause. Whether we see a short-term rally or just some sideways movement here off of this, or potentially a continuation move, but I don't think so. I think we're going to see a pause day. I think we're going to see the market try to work off some of the short-term oversold condition and maybe try and put in a little bit of a rally. But this is not a market you want to be long. You can find better trades elsewhere. This is not a market that anybody needs to be a gambler on. This is not a market you want to put your capital at risk. Believe me, folks, unless you're an experienced natural gas trader, believe me that you're putting your money into a fire. Don't get burned. It's not important enough. There's better trades elsewhere. There's better fish to fry. Forget about the natural gas market unless you're an experienced natural gas trader and you understand the intraday whippy daily intraday movements that natural gas will give you. Others, just stay away. Other better fish to fry, other markets to put capital at risk where you have a higher probability of success. And you know what? With that tonight, I think that's really all I have. It's a shorter than normal video, but if I don't have a lot to tell you, I'm not going to waste your time with a lot of nonsense. I think I got right to the point tonight. We accomplished what we needed to. So with that, I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.